APAC's asset and wealth management industry recently saw. India's asset management sector reached new heights, Singapore looked to expand the power of its financial regulator, IPOs in Hong Kong hope for a 2024 bounce back, and a boom in ETFs and equity fund launches in China. Let's take a deeper look at these, as well as other headlines and developments. And now to China. UBS, a Swiss bank, is looking to expand its presence in China's asset and wealth management sector, bucking an economic slowdown and dearth of deal activity which has weighed on the revenue of global banks operating in the Middle Kingdom. UBS's country head noted that China was a key market of global strategic importance for the financial institution and that they want to do more there, particularly in expanding the onshore wealth and asset management platforms. The comments come following UBS acquiring fellow Swiss financial institution Credit Suisse, along with its significant China presence, though UBS chose not to bring over any of Credit Suisse's 20-strong wealth management team, and the respective onshore operations of the two firms remain unintegrated. UBS is seeking a buyer for the securities firm as it already has a controlling stake in another such venture, and regulations prevent them from having two such positions. Citadel Securities, the largest designated market maker on the New York Stock Exchange, has reportedly bid 2 billion RMB for the securities unit as it seeks to expand its China presence. A local Chinese firm has reportedly also made a bid for the operations. Whilst Citadel is a licensed foreign institutional investor in China, it lacks a domestic license for brokerage operations, and buying the former Credit Suisse securities unit is seen as potentially short-circuiting the often arduous process of gaining regulatory approval to establish an entity or buy into an existing operation. Mr. Ken Griffin, the founder of Citadel Securities and darling of retail investors the world over, is noted as being relatively upbeat on China and investing in the market. Citigroup, a US financial conglomerate, is also looking to deepen its presence in China's capital markets and has received regulatory approval to launch a brokerage unit in the market and reportedly plans to hire 30 staff for the operation by the end of 2024. The number of employees could reach circa 100 in coming years via local hires and transfers from other operations. Citi applied for the license in 2021 and reportedly received conditional approval in December 2023. The approval allows the US financial institution to expand its mainland operations beyond the banking services it currently proffers, and will join fellow Wall Street firms Goldman Sachs, Morgan Stanley, and JP Morgan in having a stake in an onshore securities firm. Citi helped Chinese clients raise $20 billion in offshore equity and debt over 2023, indicating a foundational client base to potentially build on, and has already hired the CEO, CFO, and CCO for the brokerage firm. Foreign firms have struggled in recent years in China's onshore market, as previously reported. Further, of the 313 IPOs in China over 2023, foreign brokerages were involved in 3. Adding to their onshore woes is the issue of data, with increasingly stringent storage, usage, and access regulations making it difficult at an operational and strategic level for firms to effectively function. Many financial institutions are now reportedly ring-fencing their China operations, resulting in an increasingly local flavor of foreign subsidiaries in the Middle Kingdom. The main concern seems to be complying with China's strict regulations which limit the cross-border transfer of data, resulting in many firms building onshore data centers. The perceived need to do so is one reason for the time taken for Citi to establish its onshore securities unit, and one major bank is alleged to have abandoned plans for some financing services as requisite data for due diligence would not have been able to be shared. Some in the industry hope that rules may be further clarified or green channels created, which would see applications for data transfers accelerated. Such channels do have pedigree, with Hong Kong launching a program to facilitate data transfers across the Greater Bay Area. Despite the increasing costs and frustrations of doing business in the market, foreign firms continue to reiterate their commitment to it, whilst acknowledging factors beyond their control. Whilst China may be giving executives pause, other parts of APAC are attracting attention, with 2023 deal-making fees in Southeast Asia exceeding those from China for the first time since 2008, seeing $892 million in fees from the region compared to $854 million in China. This comes as IPO markets in places like Indonesia get hotter, in addition to the aforementioned issues seen in China, though they are still down on previous years, with Asia ex-Japan fees falling to $8.36 billion in 2023 from $11.2 billion in 2022. JP Morgan led in Southeast Asia, seeing fees of $89 million from equity and debt issuance, in addition to $47 million from advising Chinese companies on international deals. UBS was second, earning $76 million from debt and equity issuance services, and $49 million from Chinese clients' international deals. UBS also signed an MOU with ICBC, one of the big six state-backed banks in China, to serve onshore and offshore clients, so both these numbers may increase in the near future. Whether we see firms pivot to Southeast Asia, continue to push into China, or both, will be interesting to see. In China fund manager updates, Bocom Schroders, the fund management company joint venture between the Chinese bank and the British asset manager, has announced that it will shut its Hong Kong subsidiary, further stating that it has completed the requisite filing and procedures. This draws to a close operations which began in 2013 and help facilitate cross-border investment. Reportedly, recent years have seen activity and staffing levels reduce, with allegedly only 2 to 3 staff employed by the entity. Accordingly, the decision to shutter operations was made over 1 year ago. The decision of Bocom Schroders FMC joint venture stands in contrast to other Chinese FMCs and Sino-foreign FMC joint ventures, which have been expanding beyond their mainland China operations and establishing entities in Hong Kong. Since 2022, 3 have begun operations in the SAR, and a further 3 are reportedly in regulatory review, a response to regulators' encouragement for such entities to establish an offshore presence to boost their competitiveness and global branding and awareness. And finally, AllianceBernstein, a US asset management, research, and private wealth management firm, has received regulatory approval to commence operations with its public fund management unit, following the application made back in November 2020. The unit has registered capital of 200 million RMB and will seek to assist local investors with onshore investment products and solutions. AllianceBernstein entered China's fund management industry back in 2017 with a wholly foreign-owned entity established in Shanghai before receiving a QDLP license in 2018. With this approval, it becomes the 5th such foreign asset manager to establish a public fund WFI, in addition to those who have bought out their Chinese fund management company joint venture partners. Those pursuing the WFI route have had mixed results, with the first product from Schroders, a bond fund, raising 1.28 billion RMB from 1,933 investors at launch on 26 December 2023. This compares to 4.31 billion RMB for a BlackRock bond fund launched on Christmas Day, over 5 billion RMB for a Fidelity bond fund launched in November, and 4.09 billion RMB for a Neuberger Berman bond fund launched earlier. By comparison, many of the larger Chinese FMCs see 5 to 8 billion RMB in initial fundraising on launch. So, that is this episode's section on China. To see the full video, check out the links in the first comment below, or take a look at our profile for this episode's other sections. Do let us know your thoughts in the comments below, and if there was a topic or development that you think deserved more attention, point it out to us. Thank you all for watching. We hope to see you next time.